Hi, and welcome to Your Prosperity, a podcast series on financial topics including tax, wealth creation, superannuation, lending, audit, and many other things that we deal with here on a regular basis at Prosperity Advisors. As with all financial podcasts, any advice you hear in this is general in nature and not to be relied upon. Please contact us for any specific advice. Hi, and welcome to the podcast. Today is the 3rd of August, 2023. My name is Campbell. I'm here with Melanie Peter, one of our mortgage specialists here at Prosperity. It's been something that's been talked about a fair bit in the media lately, and pretty sure everyone with a home loan is feeling a little bit of a pinch at the moment, whether you're coming off fixed or you've been on variable. You've either hit the cliff or it's coming. So we just thought we'd talk to Mel a bit about residential sort of loans, whether it's principal residence, investments, rates, different things out there, fixed, variable, all that sort of stuff. Mel, thanks for joining us on the podcast.
Thank you, Brendan.
I guess I don't know how many rate rises in a row we've had, but quite a few. It seems to be creeping up, and even a change in the top job didn't seem to stop it, so it just keeps coming. What's the outlook? And I know you can't just say what it is. You don't know what it is. It's, who knows? But do you feel it's still going up for a bit? Is that what the analysts are saying?
Yeah, I think the banks are still expecting potentially like another one, rate rise at least. Yeah. They held in August, so they're obviously looking at the inflation figures. But the analysts at the banks are still sort of anticipating another rate rise at some point this year.
And they would probably know, you'd imagine. They're pretty good at that sort of stuff.
Yeah. And then they're anticipating in, 12 months or so after inflation really pulls back, that then they might start decreasing rates. But that wouldn't be for another 12 months or so. That's
quite a while away.
Yeah, correct.
And I guess on that, I know we were briefly chatting just before this podcast, actually, but yeah, we might talk about it later on. But we were sort of talking about, 1, 3, and 5 year rates, not so much what the rates are at the moment, but where I always see that as a bit of an indication of where the banks are thinking things are going. And you were indicating, I think you said 2 and 3 year rates were pretty good at the moment, and 5 year was a bit more expensive. Is that right?
Yeah, that's right. So the 2 and 3 year rates are the cheaper ones on offer. They're still in the 6% range, the fixed rates. But 6.09 to 6.29 would, you'd be able to, for an owner-occupied P&I, is what you'd expect for a 2 or 3 year. And then they do go up in the 4 and the 5th. Yeah, they're higher than
so
that.
I guess that similar to what you just said, I guess you're expecting 12 months before it drops, which would indicate that that's why the 2 and 3 years are a bit better right now, because I guess they're expecting it to go up a little bit, drop off. But by the sound of that must mean they're expecting in 3 years it to start creeping back up again, and getting higher. But who knows? I mean, this is the bank putting their rates out there. It could be the appetite they've got. It could be their risk portfolio. It could be anything they've got. But I sort of often look at those and think, oh, is that what they're thinking? But yeah, I'm an accountant, not necessarily a mortgage analyst, so I don't really know those things. But that's my gut feel on how that looks. What are the rates out there? I guess we got PPR, so for residential, PPR and investments. What sort of rates, if people are coming off fixed or they're on residential, what should trigger them to call you and say, Mel, you said this, I need to be talking to you. This is my rate, or this is my situation? Because it's not always rate. It's often the situation. It's the banks. It depends who you're with. It depends what you're trying to achieve. Depends on your equity. Lots of things. So what sort of rates are out there at the moment for PPR, say, first of all?
So PPR, the rates that are being offered with pricing discounts or even just, carded rates are from 5.79 to 5.95% P&I.
Okay.
And that ranges from, say, like a 60% borrowing to 80% borrowing. If you go over 80%, then the rates, sort of vary. So yeah, it does depend, but that's generally where people sit, is normally in that 60 to 80%.
Yeah, so that's where you've got the 20%, say, as a deposit, or using equity of 20% from other sources.
Yeah, correct. So to give you an idea, for example, if you were on a 6.34% rate and you reduce down to 5.84, so just even a 0.5% reduction, on $1 million loan amount over, 30-year term over the life of the loan, you'd be saving just under 117,000 in interest.
Over the life of the
the
loan.
life of the loan.
That's significant.
Which is significant. Yeah, correct.
Sorry, that's a drop from what? From 6 point.
So from 6.34 down to 5.84, so a 0.5% reduction.
And that's $100,000 saving over the life of the loan.
Yeah, over 100,000. Yes, in interest.
I mean, often you look at it and you go, it's only it's only a 1 point drop or something. That is it worth it for that? But that's a 0.5. That's a 5 point drop, as they'd call it. So 0.5%.
Yeah, correct.
$100,000 difference. Like it is worth really looking at these things and making sure you're on top of your loans. That's significant. That's a very huge amount. So definitely worth noting that. What is that's the variable rate? I think you're saying 5.79, 5.95. What about those fixed rates?
PPR? So
PPR still,
sort of coming in around 6.09 to 6.29, and that 2 and 3 year sort of fixed periods. Obviously, they're higher than that at the 4 and the 5 and the 1 year. But yeah, they're coming in around that.
So even fixed for 3 year, even though we sort of indicating they think it might come off in a year's time, even fixed for 3 years is higher than the current variable. So it's
correct. Yeah, so they've allocated a couple of rate rises there already into the fixed rates,
which is another indication.
Which is what I think that's what they're potentially anticipating, and then they would pull back. So they're hedging their bets around that. So
if people are coming off fixed, or they're just off fixed, or they're a variable, and they want to save $100,000 over the life, I like that. Well phrased. I think that's very significant. So definitely worth reviewing your life. If you're not sure of your rate, have a look into it, find out, and see what you can do. And obviously they can contact you to place that. So you place loans with all the different banks and you organize that for them, which is the huge benefit. What about investment property? So I've got a PPR, I've got an investment property. I guess the whole thing, sometimes it likely bundled up together as you're cross collateralizing, but I've come to you, I've said, all right, Mel, I'm coming off fixed, and you get me a 5.79. I'll always go with the cheapest rate you said there, Mel. I didn't go with the 5.95 you've offered.
Remember, that's PPR.
That's more PPR. Hey, I've got this investment.
So investment is.
I've got this investment property as well. What rate can you get that for?
Yeah, so they're probably coming in around 6.09 to 6.19. You might get slightly cheaper.
Okay, so that's not too far off.
Yeah, so it's not too far off the PPR rate, but it is slightly higher for investment still.
And it'll be, I guess, similar then for the 3 and 5 year. I guess it's it's up 3 or 4 points above the PPR rates for those two things. That's just how they work, isn't it?
Yeah, for like investment loans that are fixed.
So investment property loans at 3 year fixed, that'd be up there. What, I don't know, a bit high.
So they're around the 6.35 and up 6.45 for that 2 and 3 year. Yeah.
And that's obviously with 80%, 60%, whatever it is, but enough equity in there as well. That's just something to touch on, I guess, for anyone who's listening to the podcast who is a first-time listener or first-time investor. I guess two of the things with loans, the biggest things are the serviceability and the equity you're putting up. Is that it can just talk us through, I guess, how that works, Mel, just for any new players out there?
Yeah, correct. So it depends on your equity. If you already have an existing property, what equity is there, so what the borrowing amount would be. So let's say the property is worth $1 million and you want to borrow 500,000, that's a 50% loan to value ratio. So you have a lot of equity. If you had a 900 or 950, loan amount against $1 million, then you've obviously got a much higher, and you're falling into mortgage insurance and different components around lending.
So that'd be a 90%, 95% LVR if you have to borrow 900 against $1 million.
Yes.
Then that's a 90% LVR. But as you said, as long as you're not borrowing 750 to 800 or less than 80%, it's normally okay.
Yeah.
And that's your LVR is 80%. So your loan to value ratio is 80%. And then there's the serviceability side that they look at as well.
Yeah, correct. So at the moment, lenders they will look at your serviceability, your income. So equity comes into it, but equity is not part of serviceability. So then they will do a different assessment to say you actually can service this loan.
Yeah, you're unemployed, you can't afford this. Or
Yeah, correct.
you're employed, this is how much you make, get some pay slips, or you run a business, this is what the profit is.
Correct.
Yes, you can afford it. So they look at you and go, do we think you can afford it? And these days it's not, hey, I know the bank manager, I've been banking here for 40 years, you know me. It's how do I look on paper? What sort of income can I show that I'm reliably getting?
Yes.
And can I then service that loan? I've got the equity side sorted. Can I then service that, and can I afford it?
Yeah, correct. And they look at your living expenses as well, just to make sure that they won't put you in financial hardship, and that, yeah, they will take a look at, you know, what your general living expenses and health and insurance, things like that as well. So the, I guess the main component is that lenders, if the rate, for example, was 5.84, some lenders, most lenders have a 3% buffer. Some lenders have come down to 2.5%, where they stress test to make sure that if rates did increase, you still could service the loan. They don't have the actual rate.
That's really important, I think, because it's not just, you know, some people say, oh yeah, I can afford it. I'm currently paying rent at that amount or whatever it is. I could afford to continue or to take over and to pay the repayments as opposed to rent. But when you're assessed, it's not just, oh, the rate is 5.8 or whatever it is. It's add roughly another 3% to allow for if there is an increase or if there's a change or if your income drops or whatever. You know, if you're saying, oh yeah, I can afford $1 million property if my repayments are based on a 5 or 6% interest rate, but what if they're based on an 8 or 9 or 10% interest rate? Can you still afford that? And that's how they assess it.
Yeah, correct. And they also do that with any existing loans you might have. So if you have some other investment loans and things, they will do an assessment rate on those ones as well, a higher assessment rate, because they obviously don't want to put people into financial hardship.
So I guess there could be situations where you've got a loan or where the rates were good 3 years ago, or really good 3 years ago. They're actually still good. This is just normal rates they're at now. Unfortunately, we've had it so good for so long. But if you got assessed 3 years ago, and you try to get a redo it now or remortgage it now, potentially that you might get knocked back because it's on a higher rate that you mightn't be able to cover it. That's I guess the outcome.
Yeah, correct. Yeah. So they have, it has been coming out in the media just in relation to what they call mortgage prisoner loans, or people who are mortgage prisoners, where they're in the higher rates, but they can't refinance because of that buffer zone.
So they're called mortgage prisoners. So yeah, so you're kind of like, well, you're stuck with said bank at set rate or whatever they've got because you can't refinance because rates have gone up, and the stress test level of the extra 3% thrown on it has gone, is there as well. And based on that, you can't afford it, even though you're probably meeting your current requirements. If you went to reapply for a new loan, you might get knocked back and you're called a prisoner. That's nice.
Yeah, correct. So they've a couple of the banks, not all banks, but some banks have actually released like a mortgage prisoner loan policy. There is a criteria to fit, so you do need to fit that criteria.
So the banks actually call it a prisoner loan.
Yeah, some of them are.
Okay.
Not all of them, but some call it a mortgage prisoner loan.
Good to know.
And they've basically reduced the buffer down to 1%, but you do have to fit a strict criteria.
Okay, so if you've got an existing loan, you're worried you mightn't fit into the new criteria with that buffer, there are some banks who can then, I guess, put something in place for you where it is assessed at a lower rate because you're already paying a loan and got a history, I guess, or whatever it is.
Yeah, correct.
Yeah, okay. So definitely give you and I guess that's the benefit of someone like yourself, Mel. You can just, these things, you can talk to the bank, which banks have the appetite for that and who to talk to so they can arrange that. So that's very interesting. I didn't realize there was options for that. I didn't realize it was called a prisoner either, but I didn't realize there was options for that. You mentioned then, the bank some banks having an appetite for that. Which is obviously a term used in mortgage world all the time. But just to explain that, that's banks who are, I guess, keen to put residential loans on their book, essentially, isn't it?
Yeah, correct. And like some of the banks, for example, they're allowed a certain amount of percentage of their mortgage book to go outside of policy with APRA. So they have to report to APRA on all of their loans, P&I, interest only, investment, everything. And then they're granted, they also have to provide to APRA any exceptions outside of policy. So let's say they're allowed 20% of their loan book to be an exception, and that's obviously mitigated with risk, and that's what a lot of us brokers, will look at as well to obtain an exception. Then they're allowed to release, policies like the mortgage prisoner and do a 1% buffer. It's a cash, like a dollar for dollar refi. You can't get any cash out. You can't get an equity release. This is a specific sort of product. Mm-hmm. So once, that exception percentage is, reached that quota, then they wouldn't be allowed to use that product anymore because they are going outside of policy.
Yeah, right. So, but even when they're in policy, there'll still be that appetite where they might, the banks, and some banks, like sometimes it's, I don't want to pick on one, but, I'll say, looking at the big four, sometimes the Commonwealth Bank will be more keen to do a residential home loan because they've got heaps of business loans. They wanted it more resis, or sometimes it'll be the NAB, or sometimes ANZ, sometimes Westpac. I think I've covered the big four there. It's all of them will do that. And then obviously there might be the smaller other tiered lenders too, whether you're coming down to the other larger banks that are obviously out there, the Bendigos, the BOQs, whatever it is, or it might be that third tier of lending who are really keen and really good appetite for loans. And that's the benefit I get. If you just talk to one bank, you're stuck with whatever their appetite is, and it mightn't be strong on resi at the time. It might be focused on business, and they're not that interested in doing as much for you, and you don't have time to ring all 30, different options that you'd have out there. Whereas someone like yourself, Kurt, as a broker, can basically know who's looking for what and who's keen and who would fit into what box to meet a certain bank's requirements to make sure that, that you're getting the best for our clients, which we really appreciate, and obviously for anyone else out there as well. So, yeah. Look, it's, I guess it is a changing market. Times were great a few years ago. They're back to normal now, where we're talking 5 and 6% interest rates, which, over 30, 40 years, that's a pretty standard rate. So that's nothing. It's not terrible, but it's just being able to manage expectations and be in that. So yeah, look, thanks for joining me, Mel. Really appreciate it. If people want to get in contact with you, jump on the website, Melanie Peter, email you. Is that the best option?
Yeah, email, or can call the office number.
I'll put it up in the show notes. We'll have your details there if you like, and they can get in contact with you. But Melanie Peter at Prosperity, you'll be able to find her. As I said, thanks for coming on. Hopefully the listeners got something out of that. And yeah, it was good to touch base. I think we did one about a year ago, so it was a different environment then. So it's obviously changing, and as it changes, we'll get you back on and talk about it more.
Okay, thanks, Brendan.
Thanks, Mel. Okay.
Bye.
Thanks for joining us for today's podcast. Hopefully you liked it, and if so, please give us a few stars, like and share. And if you'd like to follow the series, please subscribe and pass any information on to your friends as well if you think they might like it. For more information about who we are, head to prosperity.com.au and follow the links.